Hello and welcome to Trust in Focus with me, David. Today I'm joined by Joe, an investment trust research analyst at Kepler. And today we're talking about all things China. We'll be digging in a little bit into the country and what's kind of happened in the last few years. It's been a very volatile few years, but we'll also be highlighting a trust within the sector, Baillie Gifford China Growth, which has the ticker BGCG. Now, we've got a lot of ground to cover in this video because, as I mentioned, it has been quite volatile in China over the last few years. Now, we're going to take you back to the start, 2021. If you remember, Chinese markets were riding high post-COVID, as were all markets really. But we had a few China-centric issues that we just want to kind of touch on and remind you about.
Thank you, David. And yes, I think that makes sense. Starting with painting a bit of a narrative as to why there's a bit of a stigma, a bit of a negative sentiment towards China. And we really only have to go back to 2020, 2021 to understand that. And we can start off really by looking at China's zero COVID policy. Whilst economies globally were lifting restrictions and trying to get back to the norm, China were enforcing strict lockdown measures still. And this hammered consumer demand. It disrupted supply chains and it really knocked confidence across the country. And even despite its long-awaited reopening, the bounce back and the recovery that everyone was hoping for was very much lackluster. And that kind of took the real sting out of what people thought was going to be a real bounce back in China's market. We then have to talk about the property crisis. You know, a clampdown on those over-leveraged developers, while sound in principle, just revealed some really deep structural debt issues across the sector, and that caused absolute chaos. But massive pressure on local government finances, household confidence was shot, and the growth of construction in the property sector in China was just little to nothing. You then saw a regulatory wave come through of real crackdowns on certain companies. You saw IPOs being pulled, tech giants were fined, and sectors like within education, the after-school tutoring programs were just wiped completely overnight. And this left investors with a bit of a sense of unease, a bit of a mindset to rules can change overnight. And that really didn't help with sentiment. So that together has really put pressure on China as a market and really knocked investors globally from allocating there. China's weight in the MSCI Emerging Markets Index has fallen. We've seen outflows and Chinese equities have hit historic lows when it comes to valuations. Add to that the geopolitical issues, the trade tensions that we're seeing. You know, it's no wonder and it's understandable why investors are a bit hesitant to invest in China. But I do think there are reasons more recently that give us a sense of encouragement or at least some cautious optimism as to why that outlook is changing.
Now, we have seen some stimulus from the Chinese government that was widely expected and came in September 2024. And really, it was the catalyst for Chinese markets to recover a little bit. Now, the stimulus was largely consumer focused. It's different from what we've seen in the past. It did include some relaxations of banking regulations, but it also included, for instance, interest rate cuts, which are obviously a positive for mortgage rates, but also some incentives for consumers, such as an electronics trade-in program, which allows Chinese citizens to trade in some of their old electronics for kind of newer subsidized versions, which the Chinese government hopes will kind of stimulate broader consumer demand, because Chinese citizens have managed to accumulate a lot of savings in the kind of COVID and post-COVID pandemic times. Now, this stimulus has improved sentiment towards China and share prices are up. It's the second best performing MSCI index of the kind of major countries since the start of 2024, only behind Germany. Now, obviously there are still some issues, but we believe that the property market is stabilizing a little bit. We also think that a lot of the long-term trends that saw the Chinese market boom before COVID and in the very kind of short period prior to COVID are still in place. There's still a real consumer story. The middle class is still rising in China. You know, the country is at the forefront of technological innovation. We saw that through the kind of rise of DeepSeek, as well as BYD, which overtook Tesla to become the best-selling electric vehicle manufacturer in the world. Now, we've also seen a lot of interesting consumer trends within China. Things are changing a little bit, especially with the younger generation coming through. The younger generation tend to favour Chinese brands over the Western ones where they can. This is kind of seen in cosmetics and coffee shops, particularly. Luckin Coffee, for instance, has had a lot of success versus Starbucks. It's now the biggest brand in China. Joe, with all this in mind, have we become more constructive on the outlook for China?
So I think, yes, we have been encouraged by recent signs in the market, and that's led us to have a little bit more of a constructive outlook on China. I think, as you mentioned, David, we have seen some targeted stimulus from the government come into the market, and that happened in September of last year. And that really injected a bit of excitement, a bit of a renewed excitement into the market, and it helped a brief Chinese equity rally. Yes, we've experienced a little bit of a correction around April with Liberation Day, but markets rebounded quite quickly. And I think that came to the surprise of a lot of investors, really. And when you drill down into the numbers over the last 12 months or so, the market is up almost 20%. And that compares very well relative to the global markets, despite those initial concerns that tariffs would absolutely hammer the Chinese equities. And then when you're looking at the economic data for China, there's some encouraging signs there as well. You've got the GDP stats for the first quarter of this year climbing 5.5% year on year. And that's been supported by some really accommodative fiscal and monetary policies from the government. You can then take a look at the Chinese equities themselves. Valuations are rock bottom, at least relative to their own history. And a lot of those companies, whilst being cheap for cheap's sake, others are fundamentally quite strong. They're performing well on an operational level. And those valuations really have been driven to these lows because of that prolonged exposure to those macroeconomic pressures that we were talking about just a moment ago. So there's a real sense of opportunity there for investors, getting access to these equities at discounted levels. But when you take a look at the underlying economy, there's some real exciting areas, real exciting pockets of growth that over the long run could be quite meaningful for investors in China. And we've only got to look to those areas like healthcare and tech. There's a real supportive push from the government there to start innovating, to start becoming self-reliant, to start having some tech independence. So you're less reliant on the Western markets. And whilst overnight that's not going to happen, those long-term steps, those gradual steps are really quite powerful. So you've only got to look at the likes of BYD, which overtook Tesla last year in global EV sales, and battery leaders like Cattle. And then I think something that is really quite important and often gets overlooked, actually, in the face of that flashy tech innovation story is the return of the consumer. People are coming back to the cities and they're spending more on high-end premium products, but also at the other end of the spectrum, they're returning to restaurants. Their experience spending is increasing, so travel and leisure. And I think this really comes down to that build-up, that pent-up demand from the early stages of COVID and those household savings starting to trickle through the economy, which is having a real impact on those domestic businesses. Of course, there are risks still in China, particularly with the global trade and those geopolitical tensions that we've mentioned. But we're looking at a market that is supporting through stimulus those domestic companies that are relatively insulated from tariffs. You're seeing attractive valuations and you're seeing companies align themselves with those long-term winners. And I think that could be a really powerful source of returns in China.
Now, clearly, tariffs are a risk. There are negotiations going on at the moment between the US and China, and I think it's going to be quite volatile in between, Trump's social media posts and everything. But I think that tariffs will only really be a risk to sentiment. China has embedded itself as a manufacturing hub, and it's really difficult for companies and countries to decouple from China completely. I mean, you can just witness what we saw with Trump trying to push China to manufacture its iPhones in the US. There were people who were predicting that the price of an iPhone would double, maybe even triple if they did that. So we're probably likely to see more of a China plus one rather than a complete kind of move out of China into places like US or Mexico or any other southeastern country. Now, of course, news flow will be choppy as negotiations between the US and China unfold, and we expect a lot of uncertainty and volatility in the short term. But I think it's worth noting that the investment trusts that do invest in China specifically, but also those who have exposure to China through emerging markets broadly, are kind of aligned with that consumer story in China. One of those trusts is BGCG, which we mentioned at the start of this video. Joe, you recently spoke to the team. What did they have to say? What insights did you gain from them? And why is it that we like this trust?
Yes, that's right. So we've met the team a couple of times this year, and there were some really interesting takeaways from those discussions, but also some really fascinating parts of the actual investment trust itself, which I'll go on to in a moment. We think Baillie Gifford China Growth is a really compelling way to get to that selective exposure to the opportunity set, but also the long-term, and that's important, that long-term success story that we could see unfolding in China. And backed by two very experienced managers, so we've got Sophie Earnshaw and Linda Lin, who can talk about the stocks in their investable universe inside and out, both the ones they invest in and, crucially, the ones they don't invest in. That's the kind of passion that you want to see from your fund manager. And whilst on the surface it looks like quite a vast market to cover, one of the things we really like about the Baillie Gifford Trust is they have the support of a 10-strong dedicated Chinese equities team, 7 of whom are based in Shanghai. Now, I think for me, personally, that is crucial because they are able to regularly meet management, build those long-term relationships with those founder-led businesses that they prefer over the state-owned enterprises, and deliver that critical context, both linguistically and culturally, that investors and analysts like myself based in the London office that never stepped foot in China just simply can't match. And using that experience and that on-the-ground presence, the team have cultivated a bit of a portfolio that's blending high growth, high quality opportunities with those undervalued opportunities that have real growth potential over time. And just taking a step back and looking at the portfolio as a whole, you can see that almost 80% of their revenues, the portfolio's revenues, are generated domestically from within China. You know, the managers have a real focus on those domestic-oriented, consumer-facing businesses, which, as we've mentioned so far already, are really starting to benefit from stimulus, are really starting to benefit from people coming back into the cities and spending their hard-earned savings. So the examples that we took from that meeting, some of the interesting ones that we spoke about, were the consumer-facing businesses, some of which you could say were the collector toy seller Popmart International Group and the kind of countrywide coffee house chain Luckin Coffee. Both businesses very well positioned for that increase in footfall, that increase in traffic coming back into the cities, and that excess savings pool finally being spent alongside that stimulus from the government. These are businesses that are benefiting from that already. You know, we've seen year to date that Popmart International is up 170%, Luckin Coffee nearly 40%. So there's real tangible results there. Clearly, we need to see that sustained over a longer period, but positive nonetheless. And another really interesting thing that we were talking about with the managers were the compelling valuations on offer in China. We've mentioned it already, they're historically low, and the managers are taking advantage of that, not just by topping up existing high quality positions they've got already, but introducing new and exciting positions that they've had on their radar for some time. And one example that we discussed in a bit of detail was Horizon Robotics. It's a bit of a riser in semiconductor and AI chip making, and essentially is China's answer to NVIDIA. And that's benefiting from that long-term priority of high-end tech innovation and tech independence that the country is pushing. So again, it won't happen overnight, but we're starting to see the benefits of it now. And I think it's up 86% year to date, trading at a price to book of around 6 times. And when you compare this to the like of NVIDIA, which is trading on 41 times price to book, you can really see that there are alternatives outside the US that are doing equally impressive things in the industry. And one last thing that I'll point to on the trust, which I think differentiates it from its sector peers, is its ability to access the private markets. Now, at present, that is only one position in the portfolio, and that is ByteDance. But the managers are backed by Baillie Gifford's private market teams. They've got real experience there in finding those genuinely hard to uncover opportunities for the average retail investor. And we think, whilst it comes with inherent risks, things like liquidity or valuation transparency perhaps, it offers a real differentiated source of alpha potential that perhaps the other peers in the sector or the average retail investor just won't be able to match. And I think looking at China as a whole, there is volatility, there is uncertainty, that's a given. I think in the short term at least, it just appears inevitable. And for a trust like Baillie Gifford China Growth, with its high quality, high growth tilt, performance will be choppy, particularly when sentiment turns or when its style is out of favour. But its alignment with those long-term structural priorities of the country and the government, those domestically facing, consumer-facing businesses which it has a bias to, which is providing a bit of an insulated impact from tariffs and its current discount level, Baillie Gifford China Growth could really be quite an interesting proposition at the moment. And whilst we're not advocating a full-scale shift into China, having no exposure there at all really does risk missing out on the potential recovery that may already be underway.
Now, hopefully that gives you a bit of insight into our views on China and how we got to where we are at the moment. We think there are a lot of challenges within China, and you can see that through the volatility, and we think that uncertainty will continue. But moving forward, with valuations where they are at the moment, we think that there are plenty of opportunities within the country as well. Now, we mentioned that we have a webinar that we did with the BGCG team recently. If you missed that, you can check out the Kepler Trust Intelligence website and watch it again. We also have an analyst research note, which Joe wrote, as well as a feature article, which I wrote. And obviously, don't forget to visit the Baillie Gifford website, where you can find plenty of insights from on the ground from the Baillie Gifford management team. Thanks for listening today, and we hope to see you soon.